Well, there's been a lot of talk lately about whether silver maples are actually a smarter buy than generic rounds right now because the pricing has gotten weird. So, in this video, we're going to separate fact from fiction, and you are going to walk away feeling a lot smarter and more confident in what you're buying. Today is Thursday, April 9th in New York. Let me know in the comments what day and date you're watching this from. And if you value this kind of work, subscribe and comment John A.G. Best so I know you want more of these deep dives. So, in case you haven't heard the kind of claim I'm talking about, here's the basic version. A lot of people are looking at the market and saying, wait a second, if I can buy a government coin for about the same money as a generic round, and then the coin shop still pays me more for the government coin, then why would I ever buy the round? And on the surface, that sounds almost too easy. It sounds like you found a free upgrade. It sounds like you found a loophole. It sounds like the market is just handing you better resale value for no extra cost. And there is some truth in that. There really is. When you look across dealer listings, not just one listing, not just one sale, but across a spread of current listings, you can absolutely find periods where the gap between maples and generic 1-ounce silver gets surprisingly tight. In a few spots, it gets so tight that you stop and look twice. From recent market updates, there are dealer pages with maples in the mid to upper 80s, dealer pages with generic rounds in the low 80s, and some lower priced listings where the two are separated by barely more than $1. On a few recent pages, maples and generics were effectively sitting in the same neighborhood. Now, if you're hearing that and you're thinking, okay, then this is over, maples win, end of story, not so fast. Because once you move from the buy side to the sell side, things get more interesting. More interesting in a good way if you're trying to be careful, but definitely more complicated than the simple version people repeat. See, the question is not just what you can buy for. The question is what happens when you go to sell. And that sounds obvious, but investors skip this all the time. They stare at the entry, they obsess over spot, they obsess over premiums. They obsess over whether they saved $1 here or there. And then when it comes time to exit, they discover the real test was never what the website looked like. The real test was what somebody would actually hand them for that piece, when the metal was moving fast and the shop had real risk on the table. So I started from that point. Not from theory, not from slogans, not from brand loyalty, just from that very practical question. If maples are being listed close to generics, do they still get treated better when you sell them back? Or has that advantage faded? Has the spread collapsed? Has the market decided that an ounce is an ounce and that's that? Because if that happened, then the whole argument changes. And before we get into the phone calls, I want to give you one of the opening examples that kicked this off. The first quote I got was basically this. The shop said, on the foreign silver, they were around $4 back of spot. And on 1-ounce generics, they were around $5 back. So right away, even before I had a big sample, even before I had a full list, the first thing I heard was exactly what a lot of stackers suspected. Same ounce of silver, different treatment on the bid. Not wildly different, but different. And that matters because small differences add up faster than people think. If you're selling 1 or 2 pieces, who cares? But if you're talking about tubes, boxes, or just years of stacking, that $1 edge stops being cosmetic. It starts becoming the difference between, okay, this was a smart choice, and wow, I gave up a chunk of money for no real reason. So I went further. I checked dealer pricing manually. I did not want to rely on one screen or one tracker or one stale price. I looked at multiple active listings because the market has been moving around enough this year that one snapshot can fool you. And what I found was that the old rule, where sovereign silver clearly sits above generic silver all the time, is not holding as cleanly as people assume. Some listings still show a solid premium gap, others don't. Some are close enough that you'd need to zoom in to care. And that is the entire reason this topic matters. The retail relationship has become inconsistent. To give you a better sense of how compressed things have gotten, look at the spread across a few live dealer pages. One big online seller had a current year maple in the upper 80s. Another had the same kind of coin in the high 70s. Another had maples around the mid 80s. On the generic side, you could find common 1-ounce rounds clustered around the low 80s on one platform and the high 70s on another. That's not the old world where the sovereign always sits way out in front. That's a market where the labels are different, but the shelf prices are brushing up against each other much more often than people expect. And the buyback boards tell a similar but not identical story. One published board currently shows random rounds in the mid-60s while maples are a couple dollars higher. Another has the maple in the upper 60s. But another dealer, and this is the one that keeps me honest, has a Buffalo-style round bid in the low 70s while the maple on that page sits a few dollars lower. So even online, with numbers right there in public, you are not looking at one clean national answer. You're looking at a market that still rewards recognition in many places, but not in every place and not on every day. Normally, government-minted silver does carry extra status. That's not made up. A maple is not just a random amount stamped by a private mint. It's a sovereign coin with a face value, struck by a national mint, and the current bullion version still carries 1 troy ounce of 4/9 silver. It also comes with recognizable security features tied to that series, so the market has real reasons to treat it differently. This is not just people being snobby about design. There is a chain of recognition behind it. There is trust behind it. There is familiarity behind it, and those things matter when a dealer is deciding how quickly something can be resold. Now, does that automatically mean the maple should always be the better buy? No. And this is where I want to push back on the easy conclusion. Better product does not always mean better deal. Sometimes the better-known item gets so heavily bid up on the retail side that your resale advantage is already priced in before you even buy it. In other words, you paid for the privilege up front. So the correct question is not, is the maple better? The correct question is the maple better at this price relative to the other thing I could buy right now? That distinction is everything. Because if the maple is meaningfully more expensive, then okay, maybe your stronger resale quote just brings you back toward even. But if the maple is the same price, or in some cases only a hair more, or occasionally on sale right there with generic rounds, then now you're in a very different conversation. Now you're not paying much, if anything, for the extra recognition. And that is where the idea gets interesting. Also, don't overlook the role of minimums and process. Some online dealers publish live buyback numbers, but they also require phone confirmation, shipment, and in some cases, minimum deal sizes. A local shop may be easier, faster, and worse on price. An online desk may be better on price and slower to execute. That difference alone can change what best bid actually means for you. Best on paper is not always best in practice if speed, trust, and convenience are part of your decision. So I started calling shops. Not one shop. Not the most convenient shop. Not the shop that tells me what I want to hear. I wanted a spread. I wanted variation. I wanted to hear what happened when the same question hit different desks. Because this is one of those areas where averages can hide the story. A national website may be saying one thing while a local buyer says something else. An online dealer can post a live buyback number while a neighborhood shop says, "Call me next week." Both can be true at the same time. And that, by the way, is one of the biggest lessons here already. Liquidity is not one giant pool. People talk about the silver market like it's one voice. It isn't. There is the futures market, the wholesale market, the online retail market, the buyback market, the local walk-in market, and the emergency market when volatility spikes and everyone gets weird at once. Those are connected, but they are not identical. So when one person says silver is hot and another says their local shop is barely quoting, those statements are not automatically in conflict. The first pattern I noticed from the calls was simple. In most of the shops that actually gave me numbers, maples came back with the better bid. Sometimes the edge was only about $1 an ounce. Sometimes it was wider. One shop was around 6 back on rounds and around 5 back on maples. Another was roughly 10 back on rounds and closer to 7 back on maples. Another was around 9 back on rounds and about 6 back on maples. Another had both at about 6 back, so there the edge disappeared. But if you just step back and look at the overall direction, yes, the maple usually held up better. And notice what I said. Usually, not always. That matters too, because people love turning a tendency into a law. They hear 3 or 4 quotes, and then suddenly it becomes, shops always pay more for maples. Well, no. Most of the local quotes leaned that way, but not all of them, and the fresh online buyback data shows the same thing. One large dealer currently shows maples above random silver rounds on its published buyback page. Another dealer page shows the same general idea, maples over random rounds. But another published buyback page flips the script and shows a generic Buffalo-style round bid above the maple bid. So the direction is common, but it is not universal. And that's exactly why shopping around matters more than product mythology. I really want you to catch that because it's the part that gets lost when people oversimplify this topic. The maple argument is strongest when you're talking about a broad tendency in the market, not a guarantee at every counter in America. Recognition helps, sovereign status helps, security features helps, 4/9's purity helps. But dealer inventory needs, customer flow, and risk management can still override all of that on a given day. One of the more interesting calls was the shop that basically gave the same buyback quote for both products. That one matters because it prevents us from slipping into fantasy. If a shop is going to pay the same on the way out, then your purchase decision swings back toward your cost basis. In that case, if the maple costs more, then the round may actually be the better trade. That's the kind of detail that separates analysis from cheerleading. Another call was even more revealing because the employee, almost by accident, gave enough information to expose the shop's own internal spread. First, there was some confusion about whether I was trying to buy or sell. Then the conversation settled down, and what came out was basically this. Their sell side on silver could be several dollars over spot, while their buy side could be several dollars back of spot. And when you put that together, you end up staring at a round-trip spread that is brutally wide. That is the other half of this whole discussion. And in my opinion, it's the part beginners underestimate the most. Everybody wants to talk about silver going higher. Fine. But if you buy with a heavy retail premium and then sell into a shop with a deep haircut, you're not just fighting for upside, you're fighting your own transaction costs. You can be right on silver and still have a mediocre outcome if the spread eats the first chunk of your move. That isn't fear, that's math. If your entry is meaningfully above spot and your exit is meaningfully below spot, then you need silver to travel a long distance just to get you back to flat. Not to win, just to stop losing. So when people say I'm stacking for the long term, that's fine, but long term does not magically erase bad execution. Product choice still matters, buy point still matters, exit path still matters. And by the way, this is one reason the current environment is so unusual. Silver has had a wild run. It exploded last year, it ripped again early this year, and it has been volatile enough that dealers have every incentive to protect themselves. Reuters reported silver gained well over 100% last year, and analysts were already warning about sharp corrections even in the middle of that surge. Then early this year, silver punched above the $100 area before later cooling back into the mid-70s. That kind of move is not normal, and it absolutely changes how buyers and sellers behave at the shop level. So when a local dealer widens a spread or gets picky or says, "Hold on, we're not buying today," that does not automatically mean something mysterious is happening. Sometimes it just means volatility hit their desk before it hit your expectations. Now, in my calls, there was one more thing that stood out, and I think it deserves more attention than it usually gets. Several shops were not buying silver at all. Not no comment, not call back in an hour. Straight up, we're not buying right now. Check back later. That happened more than once. That is unusual. I'm not saying it's impossible. I'm not saying it's unheard of. But if you've made enough of these calls, you know there is a difference between a shop being slow, a shop being selective, and a shop being turned off. Turned off is different. Turned off means the dealer either doesn't like the current risk, doesn't know where they want to mark inventory, doesn't have enough retail demand on the other side, or simply doesn't want to catch a falling knife or a spiking one. And here's where I think we have to be careful not to jump too far. A lot of people would love to hear that and say, there it is, proof that the physical market is broken. I don't think the evidence gets you there. It may tell you the local market is stressed. It may tell you spreads are unstable. It may tell you some shops are struggling to price fast moves, but some shops paused is not the same thing as the whole market is seizing up. Those are very different statements. In fact, the broader data argues for a more balanced read. Based on recently published numbers, physical investment demand for silver is expected to stay strong this year, even as some industrial users try to use less silver or substitute away because prices got too high. Recently published projections also point to another annual market deficit, which means this is not a market where interest has vanished. Demand is still there. The composition of demand is just shifting. That helps explain why retail and buyback behavior can look messy without requiring some dramatic end-of-the-world explanation. And that is why I don't think you should look at those non-buying shops and panic. Watch them, yes. Take note, yes. But panic? No. Not from this alone. If anything, what I take from it is that local liquidity is more fragile than people assume when the metal gets very hot. When silver is calm, everybody loves quoting. When silver starts whipping around, some desks get conservative very fast. That tells you something important about how you should stack. If your plan depends on instant perfect liquidity at every shop in every condition, you probably don't have a plan. You have an assumption. So let's pull this together piece by piece. On the retail side, the gap between maples and generics is not behaving the way many stackers would expect from an older, calmer market. There are still dealers showing maples clearly higher, but there are also active listings where the difference is surprisingly small, and in some pockets the maple is not carrying the kind of premium cushion people mentally assign to it. That part is real. On the buyback side, a lot of local shops still seem willing to pay more for the maple than for a generic round. That part is also real. Not universal, not guaranteed, but directionally real. The same trend shows up on some published online buyback pages too, where maples are bid higher than random rounds by a couple of dollars. But there is an asterisk. At least one dealer's published buyback price currently puts a generic Buffalo-style round above the maple. So if someone tells you the maple always wins on resale, they're already saying too much. The smarter statement is this. Maples often get the better bid, but you should verify your actual exit route before assuming the premium structure works in your favor. That is the adult version of the conversation. And honestly, I think it's the more useful one. Because if your goal is not to be right on the internet, but to make better decisions with your money, then nuance is your friend. You don't need a slogan. You need a framework. Here's the framework I would use. First, compare the actual out-the-door price, not the story attached to the product. If the maple is only a little above the round, or basically tied, then the maple starts getting very interesting very quickly. Second, compare the actual published or quoted buyback where you realistically plan to sell, not where some other person in another state sold, not where the best dealer in the country might buy if you hit the minimum and ship correctly. I mean your actual exit path. Third, think about spread, not just premium. Premium tells you what you're paying over spot. Spread tells you how much ground silver has to cover before you feel good about the trade. Spread is the hidden gravity in this whole business. Fourth, recognize that market stress can change everything temporarily. If silver is moving fast, quotes can widen, buyback desks can go quiet, and the neat, clean relationships on a spreadsheet can break down for a while. And fifth, don't confuse recognizability with immunity. Yes, the maple has advantages. It's a sovereign coin. Its 4/9's fine. It's heavily recognized. It has security features tied to the mint's authentication system. All of that is true. But a good product bought badly can still be a bad trade. I also want to add one more fresh layer here because I think it helps explain why silver behavior feels so strange right now. The market is dealing with two opposing forces at the same time. On one hand, silver has strong investment interest and a supply backdrop that still looks tight by annual balance standards. On the other hand, high prices are forcing industrial users, especially in solar, to thrift, redesign, and substitute where they can. So this is not a simple straight-line demand story. It's a tug-of-war story. That kind of environment can keep headlines bullish while making day-to-day physical premiums and local bids act far less predictable than people expect. And that's another reason I actually like doing these kinds of checks. They pull you back to reality. They keep you from living entirely inside big macro narratives. Because macro can be right and your local execution can still be lousy. Both things can be true. Now, where do I land on the main question? I think if you can genuinely buy a maple at the same price as a generic round, or very close to it, then yes, the maple usually looks like the better buy. Not because it's magical, not because the market owes you anything, just because you're getting extra recognizability, sovereign backing, 4/9's purity, and often a better resale bid without paying much, if anything, for those benefits up front. That's the key. Not that the maple is always superior in every scenario, but that right now, in this specific kind of pricing setup, the maple can offer a better risk-reward profile than a lot of people realize. Now, if the premium gap widens back out and maples start costing meaningfully more again, then the equation changes. At that point, you have to ask whether the resale advantage justifies the higher entry. Sometimes yes, sometimes no. But today's environment is not the same as that old default environment. That's what makes this worth watching. There's also a psychological angle here that doesn't show up on a spreadsheet. If you're trying to sell into a nervous market, highly recognizable sovereign silver can be easier to discuss across the counter than a random private mint design the buyer has to think about for 2 extra seconds. 2 extra seconds does not sound like much. In a quiet market, it isn't. In a fast market, it can matter. Recognition can compress friction, and lower friction can show up in the bid. That doesn't mean generics are bad. I own generics. Plenty of people should own generics. They can still be great low-premium silver when bought right. I'm not making some ideological case against them. I'm just saying that if the retail gap compresses enough, then their usual price advantage shrinks while the maple's resale advantages can remain partly intact. That's the window. That's the whole idea. And this is also why I think the an ounce is an ounce line is incomplete. Metallurgically, sure. Financially, not always. Markets care about form, trust, convenience, and resale friction. If all ounces were treated exactly the same, then nobody would pay different prices for bars, rounds, eagles, maples, junk silver, and old poured pieces. But they do. They always have. So the smarter statement is not an ounce is an ounce. The smarter statement is that every ounce has a context. If you're successful, share your success story in the comments so others can stay motivated. I really mean that because a lot of people watching this are trying to build something over time. They are trying to avoid obvious mistakes. They are trying to buy a little smarter than the average person. And one of the best ways to help everybody level up is to talk honestly about what worked and what didn't. Before I wrap this up, let me give you the skeptical version one more time so we're not just nodding along. The skeptical version is that all of this could be temporary. Dealer sales can change. Temporary promotions can disappear. A single volatile week can distort bids. Local shops can swing from aggressive to cautious overnight. And if silver cools off further or stabilizes for a while, some of the current weirdness in premiums and buybacks may normalize. That's fair. The other skeptical version is that if your only exit is one local shop with a bad bid, then your theoretical maple advantage may not matter enough to rescue a poor entry. Also fair. So no, I don't think this is a forever rule. I think it's a now rule, a conditional rule, a situational rule. And those are often the most profitable rules because they're based on what the market is actually doing instead of what we assume it should do. So the clean takeaway is this: the current silver market has created a strange little window where maples and generic rounds can trade much closer together on the retail side than many people expect. At the same time, many buyback quotes still lean in favor of the maple. Add in the coin's strong recognition, sovereign backing, 4/9's purity, and the mint's security features, and you can make a very strong case that the maple is the more attractive buy when the price difference is small. But do not turn that into a blind rule. Because buyback spreads still vary, some dealers pause buying. And at least one published buyback board is showing generics with the stronger bid today. That's why the best thing you can do is keep checking both sides of the trade. What am I paying today? What can I realistically get back today? And how much distance does silver have to cover before I actually feel that move in my pocket? Those 3 questions will save you from a lot of lazy decisions, and they will also keep you grounded when the market gets loud. Because right now, the silver story is loud. Very loud. There are big narratives everywhere. Some of them are valid, some of them are half valid. Some of them are just people getting carried away because the metal has already made a huge move and excitement attracts excitement. But your results are still going to come down to product, premium, spread, liquidity, and patience. It always comes back to that. So yes, I think the current setup favors the maple more than usual. No, I do not think that means you should ignore price discipline. And no, I do not think a few no-bid local shops prove the entire market is broken. What I think is that this is one of those moments where paying attention to details gives you an edge, and most people are too distracted by the headline move in silver to notice. That is exactly where opportunities usually hide. Anyway, let me know what you're seeing, where you are. Are shops near you paying more for sovereign silver, or are they flattening everything out and treating it the same? And if you've sold recently, did the quote surprise you in a good way or a bad way? Thanks for watching. And just as a reminder, this is for education and discussion only. I'm sharing how I think through the market so you can build your own process, not telling you what to buy or sell with your money.